We'll see what happens there. NASDAQ down 67. I'm so used to saying up every day. Russell down 6, and the Dow down 200. All of them basically off of all-time highs. So taking a little bit of a breather here on Rosh Hashanah. Volatility up 22 cents off of its lows, and bonds completely unchanged, 116.11. The big movers in the clubhouse, cryptocurrencies, Bitcoin trading 113.5. You can see here how it's broken out of that tight range it's had, selling off back to numbers that we haven't seen since earlier in September. Ethereum is down 2 or 3 times as much as that, down around $250, about 5.5% on a percentage basis. Oil down 62 cents. It too has been oscillating down around here up to around 64. It's 61.78. Gold, that's your big mover to the upside. New highs, up almost $50 to 37.55. Another 1.25% move. Silver also up almost 2%. That's 84 cents. Big move in silver for new highs. Net gas down small, trading just under 320, 318 and change. That's all I got. Signing off. AZO for earnings. It's not too much of a trading vehicle for us.
Yeah, the gold is new highs, but I don't think silver's not ever close to new highs.
Silver's not close to new highs?
I mean, recently, yes, but not historical new highs. Gold is historical.
I mean, all I'm looking at here is
but I've traded silver in the 60 handle before.
Understood. I'm not going back to grandpa times. I'm just going back to this year. It's a new high. I mean, listen, I remember when you could run, you could run a 30-yard dash. I mean, you can't anymore, but you could have a new fast time.
You missed me in the airport the other day then, because I had to do like about a half a mile dash. It was long.
I remember you told me.
All right, let's take a look and see what we got here this morning. Confirm and send, John. Perfect. Monday, September 22nd. How important is diversification, this person asked. Is it possible to be successful while only trading a few products?
Sure. I mean, people have done it. It's not my preferred way. I think you're missing out on a lot of other opportunities. And if it's working for you and you're only trading a few products and you feel really confident in those, go for it. I think you should broaden yourself out. You're leaving yourself a little bit pigeonholed, but I have no problem with it. And if it's working, like I said, never stop. Now, if it's not working, maybe then you got to, broaden your horizons a little bit.
I mean, we both grew up in this business only trading one product. So yeah, and I've seen some people be very successful only trading one product, and sometimes based on certain liquidity issues or other things, people can only trade a few products. I think it's more important than I think it's very important to be able to trade a non-correlated portfolio with lots of diversification to strategy, to products, to everything else. I don't think you should ever limit yourself. But could you? Sure, it's possible.
Sure.
Yeah, absolutely. I mean, we did it. I supported myself for 20 years, just trading basically one product. Let's go next slide. Do you think it's best to be delta neutral or to skew some long delta because of positive drift?
I mean, here. No, it's been best to be skewed long because we're at all-time highs. I mean, I don't want to sound like I'm not grateful for the bull market that we've had in the past. Is it going to continue? That's nobody knows. So I guess I'd prefer, at this point of view, to be a little bit more delta neutral, or maybe even skewed a little delta short. That's just me. Now you have to do what you want to do. It's worked to be delta long. It's worked to buy every dip. I don't know what's going to continue, but keep that in the back of your mind.
First of all, it's almost impossible to always be delta neutral. We're very opinionated and we get very directional, but on the show here we talk about being delta neutral because it's the best. You don't want to hear our market opinions. You want to hear us talk about things that you want to hear us give takeaways and strategic ideas, optimizing the mechanics, all the stuff that we do really well here on Tasty. That's what you want to hear. You don't care about the, if I'm bullish on a stock or Tony's bearish on the same stock, or I'm bullish on an index or he's bearish on the index. Like, who cares? That's just chatter everybody else in financial media can do. So we talk about delta neutral a lot because we don't want to make it into a directional play. We want to make it more into a strategic play. But I agree with Tony. I mean, just because the market's record high is obviously positive drift. Yeah. But we're totally fine with having some market direction, long or short. But sometimes it's really good to be delta neutral too. I have plenty of positions on. Half my portfolio is delta neutral.
Sure.
Let's go next slide. Under what circumstances would it make sense to open a position with a covered call versus a short put?
A position with a covered call versus short put. If you want to, here, let's assume that you use the same short strikes. So you're basically doing an in the money put and an out of the money call with long stocks. So if you're buying stocks, selling an out of the money call versus selling an in the money put, same strike, it's the same. And I would kind of argue that maybe you should go with the short put, not buy the stock, sell the covered call, for the only factor being if the stock pays a dividend, because it's going to use a lot more buying power buying the stock, selling the short call than it would the short put. Now, if you're just doing a put that's out of the money, two different animals, you have a higher probability of success on the short put versus the covered call. You can make more money on the covered call. So it really depends on how bullish you are on the stock. I would prefer, and I do typically, a short put that's out of the money and not the covered call. Again, personal preference. A lot of personal preference questions here, so I don't know if you okay with them. Usually you tell us what our preference is.
They are synthetically, although they are synthetically the same thing. For me, it depends a lot on a couple of factors. Obviously, I prefer the short put to the covered call just because it requires less capital. 20% versus 100% or 50%, whatever you want to borrow for the stock. But I prefer the short put because it has a higher probability of profit and it requires less capital. But sometimes I will use a covered call when the stock is cheap and I don't feel like the liquidity's there, meaning the liquidity options just isn't interesting to me, so I'll do a covered call. And sometimes I will do a covered call because I have the available capital and the covered call will give me a little bit more upside. So that's really pretty much the reason. Covered call, liquidity, a little more upside. Short put, much more capital efficient, higher probability of profit. Let's go to the next slide.
Very good.
When calculating ROI, return on investment, do you use the total premium collected as a percentage of buying power, or do you use 50% of the premium or do you use 50% of the premium collected? What the hell did I just get filled on? Oh,
Reddit, you bought back some stock, it looks like.
I had a pre-market bid in at 256.
256.09 or something.
256.09. Wow, that's good. Okay.
That puts Reddit down around $8.
$8, yeah.
Yep.
Good. No complaints there. So when calculating return on investments, use the total premium initially collected as a percentage of buying power, or to use 50% of the premium collected, since that is when you close winners. Tony?
Now, if I'm looking at return on capital, which I don't do a lot of, but let's just say I'm going to use my buying power versus whatever my profit is. So I'm gonna do the straight out, no 50% of anything else. I'm just going to use my buying power versus whatever I made.
When you calculate your return on investment, you use the buying power. So do you use the premium initially collected as a percentage of buying power? Yes. You don't use 50% of the premium collected, right, since that's what you close. You use the premium collected as a percentage of buying power. Yep, exactly.
Perfect.
Let's go to the next slide. What is the minimum account size needed to trade options as a full-time job replacement?
Oh, man. I don't have this. I don't have the. I wish there was a formula I could use to do this for somebody. But I will say this: whatever the number you think it is, add something to it, because when you have to make money, when you're going to this as a full-time replacement, it takes a little bit of an adjustment. A lot of people have a very hard time not having a paycheck, or it's the first time they haven't had a paycheck. Many years, decades, I never had a paycheck. It was something I was used to, that pressure to perform. A lot of people can't do that. So whatever you think it is, put a little bit more. 6 months of expenses plus your trading account would be my high. Would be like a broad-based number, Thomas.
I mean, we get this question so much over the years. I would say if you want to trade full-time job replacement, you're probably going to need portfolio margin. So 150 to 250, 175 to 250 would be the first place I would go. You could probably give it a shot with 100,000, much less than that. Like Tony said, you're going to need some money to live on, some other things, much less than that.
So how much reserve to live on? How much of your expenses would you say? 6 months? That's what I can.
Yeah, you definitely. Yeah. 6 months. Yeah, for sure.
So 6 months plus your trading account.
Yeah, going back to when we all kind of started in this business, we didn't need that much because
we were rats.
Well, one, we were rats, but two, we also had unlimited leverage intraday.
We did. So it's a very, very small account. I mean, listen, I started with $5,000. Could act like.
But unlimited leverage intraday makes a big difference.
Sure.
That does not exist today. So
that is correct. That is correct.
Let's go to the next slide. So this is the last one. This person writes, I have a question that I would love your help with. My account is 500K. My current buying power usage is about 20%. I feel like this is too low, but I feel like it would be pushing it if I do more than I'm doing now. I'm still learning to scale. Any advice? Do you think this is too low or appropriate for the current conditions?
Pushing it. No, I think you're there. I mean, in this market, for premium selling, 20 to 25%, I think is that's where I am. I mean, I don't know about everybody else, but it's where I am. It's hard to find high probability, expensive stocks premium right now. Easy to find a lot of expensive stocks, but premium wise, I think you're right. And it changes quickly. So don't worry, you'll have plenty of opportunity.
I just looked at my own stuff, and my buying power usage is really low right now. Mm-hmm. I'm like in the same range. I knew it's low. Usually I'm in the 40 to 50 range buying power. Sometimes I get as low as like low 30s, high 20s, but I'm actually below that right now. Mm-hmm. So I completely feel your concern. I think a lot of us are in that same boat. I mean,
you also have a lot more directional positions too.
Well, that's because I'm just bored. I'm trying to do some stuff. But these are the tough times right now when you have vol really low, and you don't lose a lot, you don't make a lot if you're trading delta neutral. If you put some directional stuff on, obviously you have a little bit more risk. But these are the times that it is very difficult to actually be disciplined, because it's easy to lose your discipline here. I mean, I'm going to go with Tony on this one. I'm okay with you where you are. I mean, I know you're only using 100K of 500K and you feel like you're way under invested. You're going to have opportunity that's going to be in your face very soon. Sure. That's just the way this stuff works. When you least expect it, expect it.
Very good, sir. You know what I got to expect? I got to expect to take a quick little break here because we got an action jive next. We're back in 90 seconds. Tasty Live.
It's option jive.
It's option
Tomas,
jive.
We're back.
It's option jive.
This is when a trader's like a caged animal, and even the S&Ps are moving two handles every 20 minutes. They get like this, and they just start talking to themselves, and
keeps me alive.
They don't pay
Do you
attention.
Want to know? Let me tell you about what I did on Saturday, because I didn't have a chance to tell you this, because it's very important.
I actually saw a picture. I think you sent it to me. You underperformed because you did this. Yeah, go ahead. Tell everybody what you did, and I'll tell them how you
Let me see if I've got a picture I could send to John so he could show.
Mm-hmm.
Thank you.
John, I'm trying to find this so I can...
You're going to email it, aren't you?
Let me see if I could send this to you, because it's very important.
Oh my God! This is Tom preparation too, everybody. So he really prepared for this.
You can't see. It's not big enough. You can't really tell.
That's what she said. It was a Saturday night, right?
Oh my!
Right. No. She already wrote me. We don't need to see this. It's okay.
John.
Long story short, Sosnoff was doing a charitable thing, and they asked him to make 8 slabs of ribs. He came up with 6, and they said, you'll like it. Is that not the truth?
Hey, so John, I'll tell you the story. So Donnie has a rib fest every year for a charity, right? And it's on a city block. And he said, hey, can you make some ribs? But I was in New York. So when I got home from New York, before I even went home, I went out and bought 6 slabs of ribs, a couple of pounds of chicken, a bunch of beans. And on Saturday morning, I cooked 6 slabs of ribs. You would have been proud.
I would have been proud. I would like a good rib.
So there was about, I'd say 5 or 6 of us that cooked, 5 or 6 slabs of ribs or something like that, or Donnie cooked like 8 slabs. So we had like 30 slabs of ribs. That's a lot of ribs.
That's a lot of ribs. I mean, did you do them all on the grill, or did you do some inside, some outside?
I started them all inside and finished them all outside. Donnie smoked them the whole time. The other guys did.
Because he's a true rib connoisseur.
Well, I didn't have enough time.
Well, you know what? No. That's for people who don't prepare. Do you have enough time? 24 hours is a long time to cook ribs, okay?
I was babysitting you.
This day didn't sneak up on you. You could have bought the ribs on a Wednesday. You're only going to go to Costco anyway. They're all blister packages. They last forever.
No, I don't like Costco.
You could have woke up early enough. You didn't have to go to breakfast.
No, I don't like Costco ribs. They're too thick, and I don't like them. I like the small baby back.
You could have gone to the butcher, got any rib you wanted to. You could have got your Iberico rib or whatever it is that you bougie people eat, and then you could have done it. Don't go to breakfast.
No, I went to breakfast yesterday with the boys.
I guess I'm not a boy.
Well, you were too busy getting your sponge bath.
Thank you.
Yesterday morning, I went to breakfast with, it was the dream team. It was me, Jules, Slappy, and Butchie.
Aww. What were you trying to do? Make a mahjong team?
We were just talking about you mostly the whole time. They wanted, they wanted a lot of information. I gave them a lot.
They were real happy about my arm. They just wanted pictures as proof.
That's right. So a lot of talk was about you, but we had a very nice breakfast. Jules was on his way to play a tournament, but she was on his way to, I'm not sure to do what. Steve was on his way. I don't know what he was doing either. But we all had stuff to do, but we had breakfast together. It was very nice. Anyway, my rib story is that we had like 30 racks of ribs around that. Maybe there was like 90 or 100 people total. And, but then I had chicken and like a million side dishes. It was beautiful.
Very nice, very nice. And did you go? You went to the Rib Fest, I'm assuming, because you dropped them off at the very least.
I worked it.
Oh, you worked it. Okay, so you served your ribs. Was there a rib cook-off? Did you make the?
No, there wasn't a rib cook-off. There was.
You didn't need like a guest rib connoisseur to try them out or something like that. Somebody who's not one of the boys.
I ate everybody's ribs. I was sick when I was left there. I couldn't move. I wanted to go home and watch the football game. I wanted to watch Indiana play. Indiana played Illinois. I wanted to watch that game. Corinne went with me for a while, but she looked at all the ribs and she goes, "This is making me sick just to smell of this."
Oh.
So, all right. Anyway, you ready?
Sounds like fun.
It was fun. If you love ribs, there was enough there to get anybody sick.
I'm sure.
Some guy made ribs where he poured he had like a lemon aioli sauce on top that was delicious.
Oh, that's different.
Yeah, like another guy did Greek ribs. Another guy did he did like,
Greek ribs. What do you do? Like, talk meanly to them from like the backside of the rib?
And then another guy did
he flip the ribs over and like cook them only like one side down or something like that?
Another guy, I'm not even listening to you. Another guy did spicy ribs. I did spicy chicken.
There was nobody who did like a Korean style rib, because I like that.
Not this year.
Well, maybe Donnie will invite me sometime.
I don't think so.
I don't think so either. I like
banned.
Donnie. I think Donnie likes me.
All right, let's do this. Ready, John? Let's do it. Option strategies with same risk profiles. Option strategies with same risk profiles. Matt, I think this is right up your alley. I think you're going to be good at this one today. Option strategies
right.
with same
Let me try.
With same risk profiles. You've been doing this for 40 years. You should know this. Option trading is strategic and engaging because of a variety of strategies available. However, the same variety can sometimes be confusing. How do you want your hot dog? There are approximately 20 premium selling strategies that fall into 8 categories. And they listed them here for you. Covered calls, time spread, jade lizard, ratio spread, iron condor, straddle strangle, put call spreads, and naked calls. These are kind of the 8 categories, then we mess with them. Let's go next slide. There are 4 pairs of strategies that are synthetically equivalent, meaning that they share nearly identical risk profiles. Understanding their similarities and differences is helpful for making trading decisions. We talked about one of these already today, the covered call versus the naked put on confirm and send. Then you could obviously do the long call spread versus short put spread, or long put spread versus short call spread, the ratio spread versus the big lizard, the diagonal versus a poor man's covered call. They're all very similar. They're all synthetic equivalents, which require matching strike prices and expiration dates.
And all would have been a great strategy in this past market that we've had.
No doubt about it. Let's go to the next slide. So the first one is a covered call, long 100 shares plus a short call. It has nearly the same risk profile as a short put. Let's go to the next slide. We talked about this already today. And voila. The the SPY at the money covered calls and puts are exactly the same. Now we would never do an at the money covered call. We would never do an at the money put. What delta would you use for both sides, Bat? As a default.
I mean, for me, I'm going to probably, if I'm going to do it, an at the money covered call with the puts. What are they? I can't see the screen that well here. What are they using? They're buying 100 shares of stock and they're selling a call out of the money. That works.
No. These are what they want to show is the same as at the money for the same, but the
they're using the same strikes here. They're using, like I said.
Yeah. They're using the same strike to show you the same thing.
Right. So for a poor man's covered call, or I don't understand the question here. I'm so sorry.
Okay. Well, not poor man's covered. For a covered call, we generally would buy stock and sell about 30 delta. For a put, for a naked put, we would.
I still sell the 30 delta. I do the out of the money.
Yeah, I mean, we usually sell the 25 or 30 delta naked put, which gives us about a 75% probability of profit. And on the call side, we usually buy the stock, sell about the 30 delta call, which would give us about a 65% probability of profit. That's all.
Right. One has, over 60 deltas, the buy the stock, sell the call, and the other one has less than 30 deltas. So they're two same trades, but completely different. That's why my answer when we did confirm and send, it depends on how bullish you are. The covered call, you're going to be able to make more money and have a slightly lower probability of success. The naked put, you're going to have a higher probability of success, make less money.
Exactly. Let's go to the next slide. So here we go, put spreads and call spreads. And like I said before, these are really interchangeable when using the same strike prices. As hedge positions, the risk profiles are nearly identical. This is another example, though, of when we buy we don't do it exactly like this. When we buy a put spread, we'll buy one strike in the money and sell one strike out of the money. And when we buy a call spread, we'll buy one strike in the money and sell one strike out of the money. And when we sell a put spread, we'll sell an out of the money put spread, usually around the expected move. And when when we sell a call spread, we'll sell a call spread out of the money, usually at the expected move. So although these have the same risk profiles, if you choose the same strikes, we generally, just like the covered call, the naked put, we would generally set up our short call or short put when we're doing a credit spread at the expected move. When we sell a naked put, we usually go to the expected move. When Tony and I do a live show, we do everything at the expected move, which is always going to be somewhere in that same delta area. And then when we're doing the long put spread or long call spread, we do it right at the money. Let's go to the next slide. And you can see here that although synthetically equivalent, professionals choose between these strategies based on bid-ask considerations. I mean, sometimes I don't really consider it a bid-ask consideration if it's a liquid underlying. I really consider it a probability of profit. If I'm going to buy a call spread or a put spread, I know it's a 50-50 shot. If I'm going to sell, but I can make more money. If I'm going to sell a call spread or put spread, I know it's a high probability trade, but I can make less money. It's just a question of what you're shooting for.
That's correct. Let's
go to the next slide. So the ratio spread and a jade lizard. They're both three-legged strategies, and they combined a naked option sale with a spread in the opposite direction. Okay, so a ratio spread is, let's just say for argument's sake here, long one, short two, and a jade lizard is short one, short a call spread. In both cases, or reverse jade lizard, just the opposite. In both cases, you're going to be naked short an option.
That is correct. That is correct. And they just broke up the strategy so that you could see them both there.
Yep, they broke it down. Let's go to the next slide. So when using identical strike prices, again, this is just to make the point, these strategies become synthetically equivalent because the embedded put and call spreads are interchangeable. In practice, though, traders typically sell out of the money ratio spreads. We do. We buy the option at the expected move, and then we sell whatever we can beyond that to generate a credit. We do this at our live shows. But the at the money jade, But Jade Lizards, we do the same thing. We'll sell the put at the expected move, and we'll sell a call spread where we can get enough credit to hopefully do the thing for more than the width of strikes. But again, the point being here is that the risk profiles are synthetically equivalent, but we do it at the expected move as a preference thing.
That's correct. And we do a lot of this on our live show. We deal with the expected move, I mean, religiously.
Yep. Let us go to the next slide. Perfect. A diagonal strategy is less commonly used. Unlike other premium selling strategies, it requires paying a debit upfront and benefits from increasing implied volatility. When using the same strikes and expiration dates, it becomes identical to a poor man's covered call. And again, we do not use the same strikes and expiration dates, but if we did, it would be the exact same, synthetically equivalent. Let's go to the next slide. And you can see it here. So these strategies are used in different market conditions. A diagonal we use for, the nice thing about diagonal I like is that you can adjust the strikes, and sometimes I'll move the front month strike. Like we made a trade on Friday where I moved the front month strike actually higher than the long strike. And sometimes we'll do that relatively close to expiration. But the poor man's covered call, it's just a substitute for a covered call. You buy an at or in the money call long term, and you sell it out of the money call either at the expected move or somewhere around the 30 delta. Mm-hmm. And we use a longer duration expiration for those, often leaps. Let's go to the next slide. So the takeaways from this, there's a lot of good content in here with these same risk profiles. Understanding synthetic positions helps traders manage complex adjustments and portfolios, and using the appropriate strategy for market conditions improves trading efficiency and reduces cost. So there's some really interesting takeaways from this. The first is that there's a lot of things, if you use the same strike, they're synthetically equivalent. But that's not how we really trade them. That's my biggest takeaway. What we do is we trade things, with a optimal duration and an optimal strike price based on expected move. I think that's the best way to do it. But to understand these similar risk profiles, this is a really good piece.
Very nice. Yes. Good job. Good job by the team. Good job by you, Sadna, finishing just about at the top of the hour, because we've got another market measure coming your way. Even the S&P, Sadna, let's take a quick look at the market here. It's actually caught a small bid. Even the S&Ps are up $5.25. Cancel crash, Sadna, as the NASDAQ is unchanged, and the Russell just went positive by 40 cents. Dow, still the weakest of the group, down 111. Volatility up a skosh, 5 cents to 17.75. Bonds going the other direction, down 4. Notes are still holding on to small gains too, but basically an unchanged market until you get to Bitcoin, that's down almost 2,000, but is over 114 for the first time that I've seen this morning. Ethereum really not catching any bit at all, down 241, although it is off of the lows that we saw earlier around 41.16. It's 42.40 right now. Oil continues its slide down 48 cents over the last couple of days, and gold getting its rally back on, Sadnov, holding steady up 50. Let's round up there. We'll take a quick 90-second break and come back. We got more Tasty Live with a market measure next. Tomas, we are back, my friend. You know what that means? Time for a little more Tasty Live. That's right, with a little bit of a market measure here. Before we do that, take a quick look at the market. Sadnov, I have a question for you. Even the S&P is down 2, NASDAQ down 15. On the upside, you got Tesla up 16 and change. You got Apple up another almost $6 on top of gains from Friday. Can this market go lower, even though you do have such stocks as, I don't know, Microsoft down almost $5, ABGO down a couple of bucks, Nvidia down a couple of bucks? What do you think? There's a big tug of war going on.
There is a big tug of war. I don't necessarily love the rotation, because I'd rather see them, I'd rather see a little more of a
go up, makes it a lot easier.
100%. Yeah, it's really mixed. My screen is mixed all over, as you would say.
Mhm.
Yeah, I don't know what to make of it. I I don't want to even consider buying them here. I'm staying short. I don't love my Nasdaq shorts.
Even though you believe it's buy Rosh Hashanah and sell Yom Kippur, you're going to keep your shorts.
Because I don't think I have enough time to get in and out. I'm not that. I'm a little slower than I used to be. I don't have that maneuverability that I used to have. That blazing, deceptive speed. I don't have that. My first step isn't as fast as it used to be, so I gotta I gotta hold the position a little bit.
Understood. Understood. Yeah. Yeah. I'll
Yeah,
give you this. I mean, I think you're at the later years of your career here. I'm going to give it to you.
yeah. It's always been
Uh,
deceptive. It's just not quite as fast as it used to be.
it's
Uh,
always been deceptive. It's just not as quite as fast. Listen to that statement.
yeah, that's exactly right. It's always been deceptive.
It's just not very fast.
Yeah, exactly, exactly. Um,
Uh,
all right, let's do this. We have a bunch of stuff. Time is it? It's 9:10 in the morning. We're in
yes.
Chicago. So if you are wherever you are in Tasty, wherever you are, you're as a Tasty trader.
Wherever you are, there you are.
Tasty Nation is all over the world, just so you know. But in Tasty Nation's home base is in the West Loop in Chicago. And if you're new to Tasty, welcome. We're like Vanetta said, we're hitting the fall season, and we still have a couple road shows left this year. So I just want to had a great show in New York. It was really fun. We're so appreciative for everybody that came out.
Mhm.
Next one is in LA at the famous Fonda Theater. We have been there once before. So funny. One of my son's friends just posted was at a concert, and he posted something. I saw it on Instagram, and he was like, "You got to check this out at the Fonda Theater." And I was like, "I'm going to be there in 2 weeks." But if you haven't signed up yet, please do. We'll be there in less than 2 weeks, Friday, October 3rd. We head out to LA on the October 2nd, so can't wait to see everybody. Doors open at 8 a.m. Show starts at 9 a.m. Remember, the market out in LA opens at 6:30 in the morning. So we'll be 2.5 hours into the trading day, which will be great. Really looking forward to it, but we don't care. Every show starts the same. The next one we do after that will be Charlotte, where we'll start 15 minutes before the market opens, like we did in New York.
Yeah.
Hopefully Tony's arm will be fixed so he can use both hands. But
by October 24th, it's going to be touch and go, Saz. It'll either be that or it'll be having an operation. But don't worry, I'm a pecker, Sosnoff. I'm a pecker. I can do it with one hand. No big deal. I'm a big pecker. You know that. I've been pecking for a long time.
Then we'll be at the Fillmore in Charlotte, North Carolina on October 24th, and we'll finish up the year in early November, November 7th, at Antone's Nightclub in Austin, Texas. Supposed to be a really cool venue, and we will be same thing.
I've had a lot of people writing to me about this. They really love this venue.
It'll be doors open at 8 and show starts at 9 a.m. And always love the quick little trip down to Austin, Texas, where we eat so much barbecue we're sick as a dog the next day. We're sweating barbecue sauce. Special appearance by our own Tom Preston that day, which will be a lot of fun. And yeah, so
be fun.
Those are the 3 last shows we have to do this year. I mean, Mike, Nick, and Katie are going to still be on the road, and Dr. Jim's got a bunch of shows, but those are our 3 shows. tastylive.com/events. tastylive.com/events. Plenty of room at these shows. New York was all full, but we always have space until we get out there. So if you want to come to the show in LA, New York, just to give you an idea, we made just about 40 trades, 39 or 40 trades. We made some pretty decent money, but that
Yeah,
doesn't.
it's a couple of scalps. We did it.
But that's not why we do it. But we did have more than our usual number of scalps. We also traded, I think, 25 different positions. I want to say we probably used about 8 or 9 strategies all total. And we had some fun with it. It was good.
We sure did. We sure did.
We used a lot of Tony's money. That's always fun. So
we had a good time, regardless of whose money we used. We guard everybody's money the same, Salzbuff.
I know. Anyway, it's a good time. So hopefully you can make it out to the Fonda Theater in LA. It's gonna be a fun show. We love LA. Yeah. Plus my kid lives there, so I gotta spend a little extra time in LA.
Sweet.
All right, let's do it.
I'm ready.
Here you go. Extreme days and next day probabilities. We're going to take a look and see what happens when we have an extreme day and then what happens like the next day.
Sure.
What do you think it is?
Oof. I'm gonna say it has really no bearing on the next day. Maybe a slight edge to a small continuation, but it's going to be within the expected move of a day. It's not going to have two back-to-back extreme days. That's the way I feel. What about you?
You know, I'm really mixed on this without seeing the data. I'm going to say that I'm going to say that an extreme day doesn't necessarily mean that you're going to have an immediate reversal or anything like that. But I'm going to say that extreme day generally means that the next day has a higher chance of being extreme as well. Just because an extreme day usually pumps up the vol. So that's why I'm thinking that. But I don't know. Let's take a look. So when you consider, and by the way, Bat, we're going to be taking calls at 9:30, right?
We are 855-238-2789 or 855-BE-TASTY. That's the number to call. I wouldn't want to step on you. You were talking about the shows and everything, so I didn't say it. But please get your phone ready. Give us a buzz. We'd love to hear from you. I got 4 or 5 lines open. We can open them now if you don't mind waiting. If not, you can wait till the segment's over and call us in then.
When you consider SPY from 2015 to present, any given day, the SPY had a 54% chance of an up day for the last 10 years and 46% chance of a down day. Given that SPY had a down day, SPY had a 55% chance of an up day the following day. Now, that's pretty much the same. So that would be in line with what Tony just said. Given that the SPY had an up day and a 46% chance of a down day, that's the same as it is on any other day. So in general, the probability of a reversion following day is only slightly higher than the probability of an up or down day in general. But so that's on a normal day, it doesn't make any difference. Gambler's fallacy. But what if the move is very large? Let's take a look. So we decided to look at 10 years of data and determine the probability that the SPY has an up day, given that the SPY has more than 2 standard deviations, or a down day. So we're looking right now, we're looking at 2 standard deviation moves, which have about a less than 5% chance of happening. We looked at 40 different tickers. So we didn't just do the SPY. Give it a 2 standard deviation up move or down move. Note it, we have a note here. Only the direction of the move, not the magnitude of the move, is considered here. So, and we have a list of tickers. We don't have to go through them all, but there's 20 different underlyings, including some ETFs and kind of like every major stock. Let's go to the next slide. All right, so normal market symmetry. In typical conditions, the SPY shows 54% up, 45.6% down, and a modest 8.8% bullish tilt, reflecting long-term market growth trends. That would surprise nobody. But post-crash reversal, after two standard deviation down move events, the up probability increases to 60%, creating a positive 4.8% edge. This suggests that fear-driven overselling creates mathematical buying opportunities. Well, that's really interesting. But what's more interesting about that to me is that it kills the theory, Tony, of the trend is your friend.
Yeah, that's what I was kind of like a little bit alluding to here. But again, you're looking at the next day. That doesn't mean what happens over the next week or month or year.
So you can see the first two slides are up day in green, down day in red. That's the 54.46. And then after that, you have up day after a 2% down or down day after a 2% up. Those are big reversals.
Yep.
Let's go to the next slide. Now we're going to look at post-rally exhaustion. So after a two standard deviation up event, the down probability surges to 58% versus 45% normally. That's a 13% shift. That's pretty impressive. So the risk-reward implication, the stronger reversal after ups versus downs suggests tighter management when buying dips and wider targets when shorting rallies. Basically, again, this is very interesting because it debunks the myth that the trend is your friend, that there's such a thing as a breakout on a big up move,
right,
or a breakdown on a big down move. This completely debunks that. Again, let's go to the next slide. We debunked it 50 times already, but we're debunking it one more time. It's a little harder to read for me as well, but in the past 10 years, among the 38 tickers reviewed, here are some that stood out with the most notable moves. McDonald's, a 25% downside reversal after rallies, only a 5% reversal after sell-offs, or 5.9% after sell-offs. Brazil ETF, a 12.5% bounce after crashes. Junior gold miners, a 10% bounce after sell-offs. NASDAQ, weak dip bounces, but sharp fades after rallies. Where's the fade here? Utilities, a 17% pullback after rallies, and Apple, a 15% fade after rallies. Let's see where we are today, Apple. Are we at a two standard deviation?
Apple's up big again.
Yeah, so the last 2 days in Apple, this is about a two standard deviation move. So we should be looking.
Rallies exhaust fast. So there's your opportunity. Look at put on a little bit more positions.
So Apple, 15% fade after rallies. And we have 2% moves in. Here, I'm going to do this right now.
I thought you might.
Because.
Plus, you got sell Rosh Hashanah.
Because, as you know, I trust our research. So I don't have a lot of time to look at options right now for a second, but.
You just went with stock.
Stock's going up faster than I can deal with it.
You could sell it.
Yeah.
Apple up $6.90.
So I just sold a bunch of Apple here stock. I'm going to do some options when we get to the next break. But I'm trusting the research here.
Apple IV rank is 14. It's neither here nor there, but I get it.
I'm looking, Tony, for I did not know the statistic before we did this study, which is what I love about Tasty Research. Apple, after a two standard deviation move, a 15% fade. We had almost three standard deviation move in Apple on Friday. I'm going to say three standard deviations on Friday and almost three standard deviations today. It doesn't get any more than that. So I'm waiting for my fade.
I like it.
Let's go to the next slide. SPY is somewhat more likely to experience a reversal following a significant update or a down day. However, it is not a strong trend. Among the 38 tickers tested, 58% were more likely to have an update following a large down day compared to generally having an update. 74% were likely to have a down day following a large update. I like those odds. And then you can see the other tickers breaking this down. 22 out of 38 tickers, 58% showed mean reversion after a 2 standard deviation down day. And what I'm looking for here is the 2 standard deviation up day. So 28 out of 38 tickers, 74% showed mean reversion after 2 standard deviation up days. That's very interesting. This asymmetry is important because it shows that markets are more reliable at pulling back after extreme rallies than bouncing after extreme sell-offs. And I assume if this is not an extreme rally, Tony, I don't know what is.
Well, this has been an extreme rally for quite some time.
I understand that. Let's go to the next slide. And some takeaways. The statistics lightly support a contrarian approach following a large up day or down day, but this basically remains speculation and position sizes should reflect that. I totally agree with that, but it doesn't support a continuation of the trend, and that's what's more important. Additionally, although the underlying price is more likely to revert the day after a large move, the options won't necessarily behave the same way because IV and duration also impact performance. Okay, I like it.
Good job. Good little study. Would you say I was more right or more on?
I would say your answer
this is a tough one for you. I got you.
I would say your answer was you kind of chickened out and you didn't really take a stance. I would say your answer is not that interesting.
I kind of chickened out and didn't take a stand.
Yeah, but you said your answer. Your answer was
that they do not. I say that they do not continue the next day, and there might be a slight edge to the upside of a continuation. But
then I didn't hear what you said. I didn't listen.
You didn't hear what I said?
I didn't listen. I mean, I've become really good at blocking out most of the things you say, so that I must have just inadvertently blocked that out.
Let me take a quick 90-second.
Let me turn off my blocker because I can turn it on or off.
Yeah, your beta blockers. Let me take a quick 90-second break and come back. We got more Tasty Live, but I need your phone calls. That's right now, 855-238-2789 or 855-BE-TASTY. That's the phone number to call. It'll be below me just a moment here. So give us a buzz. It'll be up there. I promise it will be. Call. We got 4 or 5 lines open. Love to hear from you now.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
Tasty Trade has crypto, and you can trade with 0 commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
I want to play a game. It's a relationship game. So I'm going to ask you each a question to your partner.
Who loves the hardest?
Yes, yes, yes. So are you ready? Who's more stubborn? Who's more public? And who do you think takes longer to get ready in the morning?
Oh. He's gonna do his hair.
Who's a better driver?
I mean, for sure.
Yeah.
Like I live in Italy.
Yeah.
Like we drive like
I drove a truck in New York City.
I drove a tractor on a farm. I can fly an airplane.
Who loves the Fed most? Who is more spoiled?
Oh, it's not even close. Like you got buildings full of people. What do you want, Mr. Sosnoff? I have nothing.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Okay.
I think we
Man,
got it.
you got me.
Yeah.
Oh, I don't know you that well. Short put?
Short putty.
Come on.
For myself, I wrote strangle. For him, I wrote ratio spread.
Strangle. Strangle, strangle. Strangle ratio spread.
Triangle ratio spread.
That makes sense.
Sure.
So Liz says, you say your favorite strategy is a zebra, and you got it right. And
Yes.
you said Jenny's was a jade lizard, but Jenny said hers is short put.
That's it. I'm telling the truth. Mine is, I might be.
Oh, there's a short put component to the Jade Lizard. By default, I'm accepting this.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
I want to play a game. It's a relationship game. So I'm going to ask you each a question to your
Who
partner.
loves the hardest?
Yes, yes, yes. So are you ready? Who's more stubborn? Who's more public? And who do you think takes longer to get ready in the morning?
Oh. He's gonna do his hair.
Who's a better driver?
I mean, for sure.
Yeah.
Like I live in Italy.
Yeah.
Like we drive like
I drove a truck in New York City.
I drove a tractor on a farm. I can fly an airplane.
Who loves the Fed most? Who is more spoiled?
Oh. It's not even close. Like you got buildings full of people. What do you want, Mr. Sosnoff? I have nothing.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
If you missed the live show, here's our cherry on top weekly recap.
You became Chicago's most eligible bachelor. What year was that? That was the debate we were having earlier while you weren't on the show to defend yourself.
1988.
88. So Vanetta was right. Late 80s, early 90s.
You mean when I was on the Oprah show?
Yeah.
Yeah. Well, 88. I had flowing locks like Tom.
Oprah just made it.
Oh, here it comes.
I mean,
she felt bad. She felt badly for him. You know, you couldn't get a date.
You get a car, you get a car, you get a Scott Sheridan, you get a Scott Sheridan.
I want the car.
That's right.
And we are back to look at markets that once again are inching their way to record highs. This is Macro Money. I'm Ilias Pivac, head of Global Macro here at Tasty Live. And we are going to try and figure out what it is that's going on here, because the mix of assets is looking a little bit unusual, but nevertheless, we have a week in front of us with plenty of event risk to contend with, and so we'll go through that as well and see if we can figure out where these markets are heading this week, and most importantly, where the opportunity here lies as more and more markets reach into the stratosphere. That, of course, makes things expensive and begs the question, what is there to be trading that looks attractive? And so we'll get a little update on the positions that I have on as well to try and take advantage of what's going on out here. So let's first take a look at the performance that we have for last week. We can see here stocks managed to accelerate a little bit higher. S&P up 2%, NASDAQ up 3 and some change. Interestingly, you'll note, although, of course, we got the rate cut that everybody was so anxiously waiting for, we do not get any kind of progression lower on yields. As a matter of fact, the 10-year is up 1.6%. The 2-year flat, basically telling you that the Fed didn't give markets anything that smelled particularly dovish. Nevertheless, gold up, the euro steady, the yen a little bit lower. So when we consider then what the Fed ultimately did, what we find is it wasn't dovish, but stocks liked it anyway as a kind of catch-all. What's interesting as well is that Bitcoin, which typically acts as a kind of risk appetite on steroids sort of asset that typically gives you a more volatile, bigger amplitude move of whatever is going on the baseline risk sentiment front, which is, of course, stock markets. That diverged last week, and we have here a Bitcoin that is down fractionally, 1.7%. Not the biggest move ever, but certainly interesting and something of a disconnect with everything else that was going on last week. Though, of course, for that matter, so was the stock market, and we'll take a look at why. Here's how we start the week this week. Stocks, again, inching a little bit higher. Rates going in a still higher direction, albeit not with the greatest amount of vigor. S&P up almost 0.4%. NASDAQ up 0.5%. 10-year up almost 0.4%. 2-year almost a full percentage point higher, crude oil going nowhere. And interestingly enough, for all the higher yields that we see here, gold surging over 2%. Euro up a touch, yen basically flat, and Bitcoin continuing to lose ground. In fact, this is quite the sizable decline here, at least in relative terms for Bitcoin. It's certainly not the biggest Bitcoin move ever, not by a long shot, as a matter of fact. Bitcoin tends to be relatively volatile, but this is no small move, this 2.24%, even in relative terms. It is the biggest decline in just about 3-4 weeks. As a matter of fact, going back to September the 4th will be just under 4 weeks. So certainly a sizable turn here for Bitcoin, which is an interesting, again, piece of evidence here as we look cross-market at the same time that stocks are going higher. And so one does kind of wonder what this limping upward for the stock market is all about. And of course, how it is that gold is higher when we're looking at a situation here where the yield structure seems to be moving such that we're looking at a Fed that didn't really give the markets anything particularly dovish to be looking at. What did the Fed then give, and why are we looking at the situation that we're looking at? Why is this all so convoluted? Well, here is the outlook that everybody was so focused on. Of course, the rate cut itself, the 25 basis point revision, that was well and thoroughly priced in ahead of the announcement, so no surprise there. The real sort of market mover here, as we talked about ahead of the monetary policy announcement, was the revision of the summary of economic projections. And here things get pretty interesting, because what we find is that even as the Fed cuts rates, and even as Fed Chair Powell lays out the case for cutting them, saying, look, the balance of risks has changed, the risks to the labor market have increased, we need to start to turn the dial on adjusting our policy balance in line with the shifting of these risks. So if the risk of inflation has, let's say, marginally declined, at least according to the Fed, because they think that the one-time increase to costs from tariffs will not be a lasting one. Famous last words, of course. We've heard this story before. But nevertheless, that's the core argument. And at the same time, of course, we've had a run of weakness in jobless claims. We've had a run of weakness in payrolls data. And so the Fed basically saying, look, the balance of risks has changed, and so we're going to turn the dial on policy. All that as the rationale aside, we look at these forecasts, and the Fed has increased its expectations for GDP, upgraded those this year, next year, and even in 2027. Downgraded expectations for the unemployment rate next year and the year after. Upgraded inflation expectations for next year. And given us an outlook on rates that basically keeps us in a much less dovish sort of framework than the markets might have anticipated, or indeed than they've actually priced in. So consider here the Fed nominally reduces the sort of rate outlook that they had for this year, and so basically absorbs what the market already knew going into this by at least a week, which is that the Fed is not going to do the 2 cuts they said they would do as of June, but instead are on the side of 3. And so we can see from 3.9 to 3.6, that's 75 basis points in cuts. And you can see that, of course, from the baseline of 4.4. So 4.4 was the center line for the Fed funds target, and down to 3.6 would be 3 cuts. Now, from there, albeit from this lower baseline of 3.6 versus 3.9, we have a single rate cut on the menu for 2026, a single rate cut for 2027. Now, is this dovish? Well, ostensibly, no. It's status quo for the Fed because, as we can see here, this is the likelihood for policy in Fed funds futures for October's meeting. And we can see that, indeed, we are looking for this cut to happen at the next time that the Fed meets. It was already there a week prior to today. And so at the start of last week, we can see we're not quite at 80%, but meaningfully better than even odds that we're going to get this cut. So the market overwhelmingly knew that that cut was there. So that's your 50 basis points last week and this. And then here's December. So now, today, we've actually come down a little bit, 73.6% chance that we're going to get that third cut. At the end of last week, on Friday, it was a little bit greater, a little bit closer to 80. But a week back from today, the likelihood was nevertheless quite commanding in the vicinity of about 65%. So again, much better than even. So it's not as if the Fed told the markets anything they didn't already know. Naturally, these are not 100% probabilities. These things weren't fully priced in. They're quite a bit away. So there's, of course, the uncertainty of the passage of time that has to be considered here. But nevertheless, the market saw in excess of 60% odds that we are going to get this third December cut. And of course, in excess of 70% odds that the second one is coming as of a week back from today. So days before the Fed met. So it's not really much of a dovish step here to say, oh, it's going to be 3 cuts. Yes, the market's new. So the real disconnect here comes thereafter. The Fed still has only 1 rate cut on the menu for next year, as it did in June. Still has only 1 rate cut on the menu for 2027. Now, again, lower baseline, same policy path as June was, and we can see the markets have a very different kind of a perspective. So we can see here there is, after this 25 basis point cut that's already occurred, obviously there's an upshift here because of that, we have still at least 1 cut already in. So we can see that's already there, and a greater than even chance of a third, that's there as well. So looking at this then, the real disconnect is next year, where the market, unlike the Fed, is erring on the side of 3 cuts. Now, it's not fully discounting 3, it's at least 2, and then 15 basis points in the direction of a third cut. But if we consider what that means, 15 out of a 25 basis point move amounts to a 60% likelihood that we are going to get that third cut, which is obviously miles away from what the Fed has at just 25 basis points. And we can see, in fact, why the markets reacted the way that they did, why it is that we look at this and we see, oh, the Fed cut rates, but yields went up. The Fed cut rates, but the dollar didn't fall. Well, we can look at this and see, the lows on policy expectations this year and next before the Fed, before this upshift, was hanging around 140 basis points. We took 25 basis points of a cut away, but we moved more than that. So we've gone from about 140 basis points to about 100. That is to say, we moved by about 20 basis points more, about 15 basis points more, than just a single rate cut. And so this suggests the markets looked at that Fed outcome and said, yeah, this is not dovish. This is the other thing. It's, of course, tough to call it hawkish because obviously the Fed is cutting rates and planning to cut them again. But this is not the sort of dovish leveling up that the market was hoping for. Now, why was the market hoping for it? Well, as we've discussed here before, you can see that as we were going into this policy announcement, stocks were moving higher against a backdrop of increasingly dovish expectations, especially for next year. In fact, we did this analysis before, but we'll do it again here. We can see here was the top in stocks right around the middle of February. This was also the least dovish setting this year, give or take, for monetary policy this year and next. Then the rollout of the tariffs gave us a growth scare up until early April, right here, where the market decided that the administration is ostensibly responsive to market discipline. And when the market started to go haywire right here, we got the 90-day pause on tariffs and things got walked back. And so in the ensuing recovery of sentiment, we see that policy expectations became less dovish, and that corresponded with a move basically back to where stocks broke their range, right over here. And since then, the continued build in stock markets higher has come with policy expectations growing increasingly dovish. Not because we had significant movements for 2025. As a matter of fact, things seem to have anchored there, but because the markets increasingly anticipated that 20 to 26 would have more and more and more cuts. And so it wouldn't be a stretch to say, well, the reason that we're getting this steady build higher in risk sentiment, no big swings, but just this relentless stair step upward, is that future money looks like it's going to be cheaper. And that, of course, is a boon for asset prices. But then what we see in the aftermath of the Fed move is that even with, apparently, this idea that the Fed was not as dovish as the markets and showed resistance to going that way, stock markets still went higher. Now, how does that make sense? Well, ostensibly, if we look back at the forecast here, what we find is that apparently the Fed intends to run the economy hot. Hence the higher growth expectations, hence the higher inflation expectations. In other words, what the Fed is looking to do here is perhaps let inflation stay higher for longer so as to underpin the labor market. And of course, the Fed envisions that it's going to be successful in doing this, hence the lower unemployment rate. And so perhaps what stock markets are saying here is, well, look, until this thing begins to cave in on itself, that is, if inflation were to get out of hand, if the Fed is in fact successful, should say, in boosting growth and underpinning the labor market and checking that deterioration, that's going to see inflation higher, and inflation is going to stay higher, and hopefully it's not so much higher that it becomes entrenched. And again, the Fed is making the bet that it won't. But the hope is, of course, that it won't be so high as to begin to undermine growth. And that's what these forecasts suggest, that the Fed sees that not happening. But of course, the risk is if inflation begins to build to a greater extent and to a more lasting extent than the Fed is anticipating, well, that, of course, begins to hurt consumption, which is 68% of the economy and already on soft footing after the weakest 6 months in the first half of the year in 5 years. That, of course, references back to 2020. And those 6 months, the first 6 months of that year, was the COVID lockdown. So not exactly the world's best reference point. So if we consider that in this context, we say, well, the Fed is going to basically shut one eye as it looks on inflation and say, we're going to let this thing run hotter. And until the market hits the first roadblock whereby that becomes a problem and starts to work backwards against growth, well, stocks have decided that they're going to run this until they can't or until they are shown otherwise. Whereas if we look at the US dollar, the situation is a lot more kind of textbook. The outlook has become less dovish, clearly, and the dollar seems to have started some sort of a bottoming effort, as we've been talking about before here. Here's the previous swing bottom in early July, where this massive dollar sell-off stopped and attempted to at least pause for digestion. And here is where we find that same bottom again. Perhaps now we're looking at a dollar that's going to attempt to mount a reversal. And of course, were we to do that against the backdrop of higher yields and a run-it-hot economy, that would make sense in the sense that it would bolster the dollar's yield advantage against other major currencies. Now, informing this narrative in the week ahead will be some key data points. The first batch here, looking at the flash set of S&P Global PMI figures for September. The critical numbers here, although we're going to get a slew of them from Australia, from the UK, from Japan. The key ones are from the Eurozone, where we're looking for basically stasis near the levels where we were at in August. This basically corresponds to modest growth. As ever, the PMIs are centered around 50, where that's neither growth nor contraction. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so from 51 to 51.1 is a slight positive growth and a slight acceleration from August into September. Whereas looking at the composite index for the U.S., these composite indexes, of course, taking in both the manufacturing and the services sub-indexes, there we're looking for a move from 55.1 to 54.6, so a slight slowdown in U.S. growth. And of course, nominally, we can see that the U.S. is growing here meaningfully faster than is the Eurozone. No surprise there. That's been the story since at least the middle of last year. And we focus on the U.S. and the Eurozone because we can see that the global economy, as we've pointed out before, is primarily driven by three engines. The U.S., which accounts for more than a quarter of global GDP, the Eurozone, and China. Now, we're not going to get China PMI data in this batch. That usually comes a couple weeks after. But we are going to get this Eurozone data. And so between what we're seeing in the U.S. and the Eurozone, we get the lion's share of what matters for global GDP. So we're going to see if these numbers are going to come out relatively supportive, especially for the U.S., and see if this run-it-hot idea is going to pan out and if the markets can continue to embrace it. Because, of course, if we already see signs of weakness, well, then at least the conversation around these Fed forecasts and the stock market's embrace of them as suddenly good news, whereas you might have expected them to act otherwise, considering how thoroughly they wanted the dovish version of the Fed last week, as we just saw. That narrative is going to start to get challenged and start to get questioned if, in fact, the economy seems to be going the other way. Now, for what it's worth, looking at the Atlanta Fed GDP Now model, not for its forecast of third quarter GDP, which is what it's attempting to do here, but for the direction of the data going into the model, that's the green line there, we can see most of this data seems to be relatively growth positive, hence the upward slope of that green line. Never mind what it's actually saying about the third quarter. It'll be many, many data points yet until this model is anything approaching accurate, but the tone of the data is what matters here. Another look at this from a different vantage point, this is the Citigroup Economic Surprise Index, which measures economic data surprises up or down and the tendency. And we can see here, this is the zero line down the middle here, where when we're above that zero line, as we've been tellingly since July, we have U.S. economic data looking better than expected. And as this edges higher, we can see it's actually expanding the margin by which we're getting these upside surprises narrowly. And so what this basically tells us is that economic data out of the U.S. is showing up rosier than baseline expectations have in mind. And so that, to some extent, sets the stage for these PMI numbers. If we continue to get hotter results, if these PMI numbers show us a strong U.S. economy, well, then this run it hot idea would get a little bit of credence, and maybe stocks can find some more fuel there. Now, closing out the week will be the other side of this equation, the inflation side, where we're looking at a 17-month high at headline PCE inflation at 2.8%, and a 19-month high on core PCE inflation at 3%. This is the Fed's favored inflation gauge. And needless to say, these are relatively heady numbers. And this is going to challenge the Fed's argument that inflation is something that is going to pass as the tariff increase that the administration has put forward kind of washes over the economy and works its way through the data. So looking at the dynamics here, we can see, perhaps most importantly, this 3-month annualized rate, which gives us a sense of dynamics, has now continued to increase for 3 consecutive months, showing us that the actual thrust, the momentum in this reflation is becoming stronger, whereas the 6-month rate is holding relatively steady and not giving ground. So inflationary pressure is building here. And so between the PMIs and this inflation report, we're going to stress test the Fed's argument here and see if the markets continue to buy it. If they continue to embrace the idea that we can see the dollar, say, and stocks going up at the same time, even as yields have stopped falling, at least in the acute sense. Now, positioning-wise, not a whole lot that I've changed here other than increased my exposure to the dollar. We're looking for it to do as we've discussed here and attempt to bottom. So I'm short the Aussie here, short the pound, short the euro, short the Canadian dollar. I still have my longer term exposure to Brazilian stocks, but this is not exactly a speculative idea over a nearer term. As we can see, there's 100 days to expiration here, 116 days here. This is looking for end of year and into January. It's working, but it's not anything that I'm looking to tinker with in any kind of near-term sense. We have still this long position in gold. That's working. This is being done through selling puts at 330, and we can see now that we're at 344, almost 345, that's working. On silver, that's a trade that was taken later, and so in this case, it's a straight up calls vertical from 38.5 and capped out at 47. We can see that's working as well, albeit more modestly, and taking a little bit of a stab at the long side of the bonds. It looks like we've had a decent pullback, of course, last week, but if the markets are going to say that there's all this easing in the pipeline and the Fed is resistant to doing it next year, maybe even the year after that, then ostensibly those rate cuts need to move further down along the yield curve. And so looking for that part of the curve, the long end, to start to price in some lower rates even as the front end holds. And so a call vertical there with 60 days in time to sit and wait and let this work itself out. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go from there. A little bit of a special schedule this week. We're going to be off tomorrow, back on Wednesday. As ever, I am also writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back this week on Wednesday. Happy trading.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies. Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions: Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Zach, South Carolina, how are you, my friend?
Hey, I'm good, guys. I just wanted to let you guys know and Tasty Nation know that I've been following you guys for 3 years. Where else can you call two real traders? They pick up the phone and answer your question. There's so many so-called traders out there that give you vague strategies and want you to buy their course to learn more, but you guys at Tasty put all your info out for free, and all you ask in return is for us to use your platform. Thanks as always for what you guys do.
Love it, man. Thanks.
Thank you, man. Thank you. I really appreciate it. Very kind word.
Got friends?
get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Delta, Vega, Gamma, Theta. It's all Greek to you. Well, guess what? Millions of people speak Greek, so you've got no excuse. Here's your alphabet. Theta is time decay. Time itself has value in the options world, and that value slips away the closer you get to expiration. Theta is how fast that happens. Tick-tock, time value drops. Delta is difference. How much does a $1 move in the underlying affect the price of the option? Long options have a positive delta because their value moves with the stock. And short options have a negative delta because their value moves opposite the stock. Gamma is get up and go. It's how fast delta changes. Gamma increases when the options start trading much more like the stock. Like the closer to the at the money and the last few days till expiration. Vega is not a Greek letter, but it does start with a V, and so does volatility. Vega measures how much the options price is affected by the changes in volatility. Now you know your alpha, beta, gammas. Well, gamma anyway. Pretty simple.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Zach, South Carolina, how are you, my friend?
Hey, I'm good, guys. I just wanted to let you guys know and Tasty Nation know that I've been following you guys for 3 years. Where else can you call two real traders? They pick up the phone and answer your question. There's so many so-called traders out there that give you vague strategies and want you to buy their course to learn more, but you guys at Tasty put all your info out for free, and all you ask in return is for us to use your platform. Thanks as always for what you guys do.
Love it, man. Thanks.
Thank you, man. Thank you. I really appreciate it. Very kind word.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Delta, Vega, Gamma, Theta. It's all Greek to you. Well, guess what? Millions of people speak Greek, so you've got no excuse. Here's your alphabet. Theta is time decay. Time itself has value in the options world, and that value slips away the closer you get to expiration. Theta is how fast that happens. Tick-tock, time value drops. Delta is difference. How much does a $1 move in the underlying affect the price of the option? Long options have a positive delta because their value moves with the stock. And short options. Now you know your alpha, beta, gammas. Well, gamma anyway. Pretty simple.
All right, we're back. Tasty Crypto Show. I'm Dan Cecilia, and with me for the first time on the show, but a regular on the Tasty Live network, is Errol.
Yes.
Errol, what's up, man? Thanks for joining me.
Dan, thanks for having me on here, brother. I know we've been meaning to connect a little bit more. It's going to be nice to just have a nice conversation today. You guys have such fire intro music. I'm already taking notes.
We got
on our show.
Yeah, we got an awesome intro music, little DMX. I don't know what would be the intro music that you'd want to go with.
I don't know, but I would take. I'm down for the DMX too.
Yeah.
Put a little more thought into that. But no, it got me hyped as we were loading in here. But no, thanks for having me on here, brother. It's gonna be fun.
Yeah, thanks for joining us. We got a light show today, but I wanted to get you on, get you chatting markets. You know, I think we'll take a quick look here. Bitcoin's been down. We had a big run up over the last couple months, and kind of a little sell-off over the weekend here after the Fed announcement, Fed rate cuts last week. Everybody thought it was bullish. Now it's bearish. I have trouble following it, but typically I'm in it for the long term. But tell me a little bit. Do you have background in crypto? Are you interested in crypto? Because I don't think we've ever really dug into it.
Yeah, not much of a crypto trader.
Okay.
Not yet, at least. No.
Not yet.
But no, more of just a long-term hodler.
Okay.
Comes down to crypto.
Okay. What are you holding?
Bitcoin.
Just Bitcoin. Okay.
Bitcoin, Ethereum. I might still have a little bit of Cardano. That was more so like I like Cardano like 5 years ago. I might have a little bit of that, but really Bitcoin and ETH, the top two.
Okay, and you've never done anything like on chain. You never interacted with like dApps or.
I mean, yes, I've had the wallet. I mean, I was getting into the NFT craze. I think that was a really good learning experience a few years ago. I kind of missed that era.
Yeah.
Even though I wasn't like an NFT guy, I'm not a blockchain guy, but it was fun. I remember the gas fees were outrageous.
Yeah.
Around that time.
Yeah.
But no, I'm not super. This is not my neck of the woods by any means. I know the words, I understand the basics, but I'm not actively dealing with these dApps and those type of technology.
Okay, well we'll have to get you into it a little bit more because there's been a ton of updates since NFT craze. Like I think there's just been a lot of great apps launched, and Solana's another one where if we're into Cardano, Solana would be the next spot for you to kind of check out. So I'll have to get you set up with a wallet, or maybe we dust off the Tasty Crypto wallet if you still got it.
I have to do something.
Yeah.
But yeah, nothing too crazy.
Okay, so let me kind of put it on you if I can. What do you want to know about crypto? Like, is there anything like burning questions? Anything that?
So
yeah.
Great way to put it to start. Because actually, yeah.
Okay.
It is. That's why I'm kind of glad to talk with you. That keeps up with to speak with you. That keeps up with the industry regularly. I was super excited about Ethereum.
Okay.
Ethereum showed more utility than Bitcoin. Bitcoin more of a store of value kind of thing right now. What's the state of Ethereum right now? What are the developers building? I would have just thought that. So everybody was like, yo, these NFTs are going to be worthless, this, that, and the other. But it's like, yeah, but this was a perfect example to show what the blockchain and the technology can do, you know? So I'm just confused at the state of the blockchain and where Ethereum is at. And are we waiting for the next cycle to see more things being built in this space? Have they already been built? I'm just not in the space day to day. So I'm kind of lost there. Where are we at?
Yeah, so I think it's a great question. And I think Ethereum has garnered a lot of attention, but also a lot of mixed opinions, a lot of hate, a lot of people love it, people hate it, people think it's, the next money, online money, people think it's worthless.
Yeah.
So really, since the NFT craze, we've had a lot of updates to the network, right? So number one, we had something called the merge, and the merge moved us away from proof of work to proof of stake. So making it basically completely energy. Like there's no energy, there's no proof of work. Like you don't need mining or anything. It's all proof of stake now. We have the rise of layer 2s, right? So basically over the last couple of years, you mentioned gas fees. Over the last couple of years, they've created these things called layer 2s, which are essentially built on top of the Ethereum blockchain. They're their own individual chains. So one's called Base, which was launched by Coinbase. So Coinbase has launched their own. Robinhood's coming out with one.
I don't want to get too far ahead.
Yeah.
That would be considered the dApp.
That would be considered a scaling solution for Ethereum. dApps would be like Uniswap. So like decentralized exchanges like Uniswap, where you don't need like you don't need a central party to clear the market for you or make the market for you rather. You can just go to these apps, connect your wallet, and make a swap.
Okay.
So that would be considered a dApp. I guess like OpenSea, which is where NFTs were traded, is considered a dApp. A number of these applications, though, to your point, when they were built on Ethereum layer 1, they were expensive to run because of the gas fees.
Right.
So the layer 2 is basically a scaling solution. It's kind of like another chain built on top of Ethereum to allow you to run apps cheaply and efficiently.
Okay.
So, yeah, I mean, I can pull up Uniswap if we want to take a look at that, and I can show you how to switch the network. But basically, really, all we really have now on ETH is the switch to proof of stake, which makes it easier for these applications to run. And now we have layer 2s, which essentially make it cheaper to process transactions and send everything to ETH. So. NFTs have come back a little bit. There's actually this cool there's actually a really cool, not to get too far off topic, there's been a cool mechanism that somebody launched a token, and it's called Punk Strategy.
Okay.
Are you familiar with CryptoPunks?
I am familiar with the CryptoPunks.
Okay,
That's where it's branching off of.
Yeah,
Okay.
so they like launched something where it's a token, and it has this like mechanism, and where the fees from the token trading, they go out and they buy CryptoPunks. So they'll buy the CryptoPunk and list it at two times higher than the floor price.
Okay.
So it's kind of like sparked this new NFT craze. But anyway, NFTs are still around. People are still collecting them. Obviously not as crazy as 2021, 2022, but still here, still collecting. I mean, I bought one last week. By an artist called Jack Butcher. Probably not familiar with him.
Jack Butcher sounds so familiar. Is he on Twitter?
Yeah.
I might have came across something.
Yeah, he's like he kind of does like generative art. It's like a popular NFT artist. He launched one that I bought last week, went pretty crazy. But anyway, there's a bunch of stuff going on. I've jumped all over the place, but essentially what we have now is we have a scaling solution for Ethereum that allows cheaper transactions.
Okay.
And honestly, better applications to be ran.
So why does this have cheaper transactions? What's going on logistically to where they can reduce that?
Yeah, so I want to preface this with I'm not a dev.
No, you're totally fine. So the way that I see it is what I known as gas fees. The gas fees were higher the more interaction that was going on the chain.
Yeah.
Right, this is like a line.
Yeah.
So to me, I'm just like, okay, is it because they haven't scaled to the level to where they want to be at yet? Why it's efficient cost-wise right now? And maybe that's a question because of my lack of understanding. It might be a little bit of an ignorant question.
No, it's not ignorant. Let me try and explain it in a simple way. So basically what happens is just like in a normal tech stack, like you don't have to run your own server instance, right? We we build everything in the cloud now.
Right.
So it makes it cheaper, quicker, whatever, faster for us to build applications and host them in an AWS server, Google, whatever. So there's a similar idea there where like if you could think of the layer 1 Ethereum as sort of a physical instance of a big server, most people don't need all that. So they build this layer 2, and on the layer 2, it allows you to bundle transactions together.
Okay.
So you're bundling a bunch of data together. That's happening on an application or whatever, and then you are sending that bundled transaction, that data, it's all packaged up back to the layer one Ethereum for verification. So most people are just interacting with like a single instance or a single kind of part of the blockchain, and then once all those transactions kind of get packaged together, they're sent to the layer one. So actually, we went through this last week. Let me bring it up real quick.
Yeah.
Transaction. Yeah. So really technical though. I mean, here we go. So all the layer twos are protocols built on top of the layer one. So it just improves scalability, like I said, lower fees, faster confirmation. They're called roll-ups. Like I said, you roll up the data, package it up, send it to the layer one for processing.
Okay.
So similar to how you don't interact with like a massive server, you interact with an application that's hosted by a cloud server. Same type of idea. There is this interesting.
I thought this was a ball pool for a second. Oh, that is a ball pool.
It's actually a visualization of the blockchain. So
these are South Park people.
South Park people, yeah. So basically, what you're seeing here is on the left you have Ethereum, on the right you have Bitcoin. So these little South Park people are all basically transactions, and this is the block. The bus is the block, right? So see how Bitcoin is slower. It's a larger block. ETH is a little bit quicker, and they kind of are waiting to get in line. And there's kind of these levels, these different ones, and if you pay more gas, you get in this first block and you're submitted to the blockchain quicker, right? So
cut the line fee.
Cut the line, yeah. There's these little green blobs, and those are the package data I was talking about from the layer two.
Which ones are those green blobs?
They're these things. So if you click on it, see how it says blob?
Yeah.
So it kind of shows you it's essentially a package of data from a layer two.
Okay.
So let me see if I can find the layer two here. Change street. Arbitrum. Okay. So Arbitrum is an example of a layer two. So see how on the left here, you still have them all queuing to get on the bus, a little bit slower. Over here, all these transactions are put in their package. They're like mailing their package here.
Yeah.
And here's the mailman, and then they get on the escalator, and they're kind of all waiting to be packaged together to send to layer one. So in a minute, you'll see all these packages kind of be scooped up and sent off to Ethereum, which is over here. So it's just a visualization of what's going on the chain.
Extremely helpful, by the way.
Okay, yeah. I struggle, like, it's abstract. You need a visualization.
Absolutely. Yeah.
And then over here, these are applications. So this is Uniswap. So you can kind of see Uniswap is a decentralized exchange. It uses liquidity pools to make markets without the need for order books or central facilitators, right? So no New York Stock Exchange, no Chicago Merc Exchange. It's using math and a different mechanism to basically cut out that middleman.
Yeah.
That's how markets are made in crypto on decentralized protocols. So it's called an automated market maker. I don't know if you ever came across it, but that's...
You're talking about Uniswap?
Yeah.
Yeah, I've used it before. I've lost money in it. I tried to transfer some tokens. I don't know where. Like that, you know what I'm saying?
Yeah.
It was just trying to learn by trial. And I think I got something in a wallet somewhere. I've tried to swap tokens to exchange it for wrapped ETH. I was doing the wrapped ETH and ETH. I needed something along those lines. And clearly, as you can see in my dialogue, there's somewhere.
It happens. Right. I think the first couple of transactions I did, I've lost money.
Yeah.
I got stuck. I didn't have enough ETH for gas. I think that's like the most annoying part is when you go to submit a transaction. You're like, I have money in here, and then it's like
the gas fee.
Or whatever. So early, that's the early adoption kind of trying to overcome some of the just early tech stuff.
I knew it was I knew I was kind of walking with my eyes closed a little bit. It was a new space, but it happens.
I honestly think like if you can get over that, you're like 90% of the way there.
I'm extremely excited.
Yeah,
I'm extremely excited to ask you more questions.
I need to show you at some point. I don't know if we'll be able to do it on the show today, but I need to show you Solana because Solana will make it 100 times easier for you because you don't have to deal with like wrapped ETH. You're not dealing with any of like the gas fees.
Yeah.
It's really quick.
But is the wrapped and wrapped ETH still important?
Yes.
Okay.
Yeah, and it's still important. The thing with ETH is like because it was one of the first, I guess, layer ones that had smart contracts. They built like the ETH token isn't actually like an ERC20 standard, which is what like the protocol is for tokens. So that's why they had they need a wrapped ETH because you needed to wrap it in the like ERC20. Yeah, it's like super tech nerdy stuff, but they just built it. They essentially built it wrong.
Yeah.
So it's just early tech hiccups is what I could say.
Yeah.
But still important. There's still like a reason for it to be there as far as like facilitating liquidity markets. It's definitely like something that's necessary, but I think they probably just built like it's kind of annoying to deal with that. So that's why I say Solana is probably a better blockchain for you to maybe be. We'll take a look at some point. But yeah. So anyway, ETH scaled. We don't have to deal with as many gas fees. Still, has that sort of supply and demand economics, demand for block space. More users using it, gas fees go up. There's another mechanic where it's deflationary. So the supply of ETH is being staked, which means it's being locked up to earn a yield. Similar to how you would purchase like a bond or whatever, you're kind of locking up your cash. Not necessarily a dividend, but more of like you're locking up your cash in let's say a CD or savings account, and it generates a yield. So there's another site you can track this. Just sound.money. Basically, since it's gone to a proof of stake mechanism, you're reducing the supply because people are staking to initiate transactions, right? So on the left over here, if you could see my screen, here's like the supply rate, and it's basically at like a slightly positive on a 7-day time frame, 30-day. Here's like a 3-year time frame. So at one point after we merged proof of stake, it kind of was deflationary, meaning more ETH was being burned than being minted. And now it's slightly inflationary, but if you look at if we didn't merge it, if we didn't go off a proof of work, it would have been super inflationary. So yeah, so it's just
kind of have to rip the Band-Aid off.
Yeah. So it burned. We're burning like 700,000 Ethereum a year. It just kind of changes the supply demand mechanics of ETH. So less ETH on the market kind of affects the market cap, kind of affects circulating supply.
Yeah.
So and here's some gas statistics. So we've been able to reduce gas. They've been able to reduce gas fees pretty significantly. So back when you were talking about the NFT markets, you can see here base fees were massive, right? Like 64 Gwei, which is just the unit. You see spikes here, right? And now since we've gone proof of stake, it's been pretty low. It's been pretty manageable.
Yeah.
So even with people using it, it's kind of been pretty manageable. Not as crazy as when you were doing NFTs. So I think what's interesting is they've been able to upgrade the protocol to, I guess, manage the demand, right? Because if they made it non-upgradable, then you would just nobody would use it.
Yeah.
It'd be way too expensive to use. So, just kind of an overview of what has been going on since you were, I guess, last deeply.
It's been a minute.
Yeah.
No, I'm excited. I'm excited to ask you more questions too, just because I think decentralized assets in general always extremely interesting.
Yeah.
Especially decentralized exchanges.
Right.
Unironically, I think are extremely interesting too. So, it was a nice update, kind of just where we are with things.
Yeah.
Because I didn't even know where to start. I was like, man, where are we at with crypto regulation? They got to be lobbying to not get these crypto banks running and decentralized exchanges. Like the banks got to be fearful of that. So those are some things that been crossing my mind.
Yeah, for sure. I mean, I think if you want to take a look at, you're talking about DEXs, you're talking about some of the regulations.
Yeah.
I think we should take a look at like DeFi in general and just see like what's going on there.
Right.
Obviously you heard of stablecoins. I think if I'm taking a step back, I think the biggest innovation in the space was a stablecoin. Just the
You
fact,
think it was?
Yeah.
You think in terms of needing that to move forward?
Yes.
Okay.
for anything, right? Because why would you like? We don't price things in gold. We don't price things in platinum. Like we price it in dollars, a stable unit of exchange. We didn't even have this until we didn't even have something like a digital dollar until like 2020.
Okay.
So think about like 5 years ago, there was like no such thing as like liquid stable.
I can't believe that. Actually. It kind of feels surreal.
Yeah, exactly. Like I remember earlier.
2020, what?
Yeah.
2020.
And like think about it too is the gas fees that you're talking about with like Ethereum came out in like 2014, 2015. There was no such thing as a stable coin. So they had to price everything in Ethereum, making it way more confusing. And you know what I mean? And so like the fact that we have this digital dollar now that is a stable unit, it makes everything work so much more efficiently. Like if I want to like pay you, like you make a video for me or you come on the show, I want to pay you. Like, I don't know, maybe you would accept ETH, but more likely you would want a dollar.
Exactly.
You know?
Yeah.
So just kind of
by default.
Just by default, yeah. So I always take a look at this tool, DeFi Llama. You can see stablecoin market cap here. Total value locked in DeFi, 150 billion. So DeFi really, like, you can go back to like 2017, even 2020. We only had about 500, 600 million. And then 2022, last cycle, popped up to 167 billion, all-time high. And then FTX and Terra Luna and all the kind of big crash happened. We bottomed out at 30 billion, and now we're kind of on the rise again. And I still think we're kind of peaking out at a local top of last cycle. So I think there's more room to run. But yeah, like 5 years ago, this wasn't even like a liquid market.
That's nuts.
Yeah. So just kind of trying to put things in perspective of where we're at in the space. Stablecoin market cap, about 290 billion. So digital dollars, right? Digital representation of a US dollar, we got about 300 billion worth of value.
Okay.
Which is tiny relative to every other market, but
it's emerging though. We're
pretty big. Yeah. Pretty big. So I always say that is like the most. Take a look at the market cap chart. Yeah. So 2020, there was only $5 billion worth of stable coins. So 2018 is when this first started being tracked, which is, I think, was when Tether came out, 30 million. So yeah, we didn't even have like digital dollars until like 5 years ago.
Yeah, literally since yesterday. That's wild. The space is moving quick though. It feels
super quick.
I mean, when you brought up that point of 2020, it's like, no way, only 2020. It was like yesterday.
Yeah.
But
yeah,
I'm still excited.
Yeah, so there's a ton of stuff going on. More liquidity in the space. I really think, like, for me, the big thing you got to get over as a beginner is losing your money to gas fees or whatever. Don't lose a seed phrase, hopefully, but
not that one.
Yeah, but it's something that everybody goes through. Like, I've been hacked. I've lost a couple thousands of dollars being hacked, clicking on a phishing link. It's kind of like early internet, right?
Exactly.
Like you had
wild west sometimes, especially 2020 when it was all popping up.
Yeah, very wild west.
It was a wild west.
I could tell you so many stories about just crazy stuff happening, like buying pictures of monkeys for hundreds of thousands of dollars. Right. I remember I had a buddy that was helping me like mint NFTs. We minted a picture of a mouse, and the next day it was like worth 20 grand. I was like, just like stupid stuff happening. It was peak mania.
Right. I mean, peak, right?
Yeah.
I mean, with social media, it's arguably more peak mania than 98, 99. A bigger deal, internet, I get it, but we had social media to really fuel the fire.
Yeah, exactly. So, I think it creates a bigger feedback loop. I think it creates more mania. It's internet capital markets.
Yeah. And more early adopters.
Yeah.
Right? If that wasn't happening, I probably wouldn't have been familiar with these things, and at least knowing that I need to become even more familiar. I wouldn't have known the importance if that didn't happen.
Right.
Maybe I would have, but I don't know if at that time.
Yeah. I think social media kind of made it, at least Twitter made it kind of move faster, right? Because I think pre-2020, you had to be deep in like Reddit forums and like,
pre-2020, people were, let alone crypto, people were barely trading options and futures and stocks, let alone crypto. So yeah, you're right.
Yeah,
it's very few and far between. At that
COVID
time.
was an accelerator. I feel like
it was a launching pad.
Stuff. Yeah. But how about how about you? Like, what are you paying attention to? Even away from crypto, are you stocks or
A lot of futures.
A lot of futures.
Love the futures markets, actually.
All right. Are you familiar with perpetual futures?
No, I'm not.
Okay. This might be something that was interesting to you. So, in the crypto markets, there really isn't this concept of dated futures, right? Because it's a 24/7, 365 market.
Right.
So we have this concept of perpetual futures. This is what drives most of the future markets, derivatives markets in crypto. So it's just a trading contract that lets you basically bet on whether crypto is going to go up or down without actually owning the crypto yourself, right? Similar to futures, but they don't expire. There's no such thing as like dated expiries or anything.
Okay.
So traded on exchanges. Some are decentralized, some are centralized. Binance, Bybit are a couple examples of centralized. I'm sure you heard of Binance before. Hyperliquid, which is a very popular one that just emerged over the last year, is a decentralized one. And again, relatively small. I think 40 billion is open interest over 24 hours. But basically, you're trading off of a funding rate. So it's kind of like a swap, right? So you're not actually, there's no expiries or anything. You're just sort of betting long or short and paying, if you're long, you're paying a funding rate, so you're paying interest to the short seller, and then vice versa, short seller is getting paid by the long. So there's a spot price, and then there's there's a spot price, and then there's like a future price, and the funding rate kind of keeps it in line.
Okay.
So you can take, you can go up to 100x leverage on some of these.
Oh, wow.
So yeah, so it's pretty big.
Okay.
The one I use the most is Hyperliquid.
That's the decentralized one.
Decentralized one. We'll see if we could take a look at it. I hope it lets me on because these aren't available in the States. But so if you're overseas, you can do some of this decentralized. Coinbase just launched some. But basically, here you have, we'll do Bitcoin US dollar. So on Hyperliquid, you can go up to 100x leverage. There's a mark price and an oracle price. So like I said, mark price is your spot, your oracle price is your future. It's just different ways of representing the name of the price. So they're slightly different. So the mark price is typically the spot price is cheaper than the oracle price. And then there's a funding rate. So just the funding rate here is about 10% annualized. So if you keep the position on, you're paying 10% and basically to finance the position. So let's see here, size. I'll do 1 Bitcoin. It won't even let me because, oh, there we go. So basically, if I were to trade 1 Bitcoin in size, your liquidation price would be 108,000 per Bitcoin. Order value would be 112, so I'm just putting it at the mark price. Margin required 5,600. So this is where you get into like futures margin to own 1 Bitcoin worth of a size of a position. You need about $5,600, right? And then there's some fees and whatever else here is represented, but basically all you need to know is that you would get liquidated off of a liquidation price. So as long as it doesn't touch that, you're pretty fine, but you're paying interest. So that's another, you're financing the position. So that's kind of another little wrinkle.
So financing the position. So regardless if you profit or loss, you have to factor in what you're paying. Okay, that makes sense. So I used to short a lot of small cap stocks like years ago, 6-7 years ago.
Sure.
And you had to use certain brokerages because you had to borrow the shares. You had to reserve the shares to short it beforehand. So a lot of the times, even if you didn't get the opportunity to short, you still paid the fee to reserve the shares.
Right.
So you still have to factor that into the cost. But that's just what came to my mind right off of the bat.
Similar idea.
Okay, so regardless of if I make or lose money, it's still a cost I have to factor in.
Right.
Okay.
Right. And the funding rate actually changes. Like this funding rate is supposed to keep this mark price and oracle price like in line, right? Okay. So the mark price will always kind of converge to the oracle price. So that funding rate, whether it's big or small, depends on like how far those two prices get out of whack. So it's like it's kind of like it's like an arbitrage that keeps the price in line with what it's actually trading at.
Okay.
And then it changes every This one changes hourly. So every hour you're paying this rate. If negative, shorts pay longs. So if it's a negative funding rate, shorts are paying the longs to finance the position. If it's a positive rate, longs are paying the shorts.
Okay.
Yeah, so like you can do different things. Like you can do like ratio trades. You can do, I mean, like you could go long Bitcoin, short the altcoins, right? Some of these have massive funding rates, especially like newer launch coins. So there's some interesting strategies there. It's just something a little bit different than I think traditional markets, because traditional markets typically go off like dated expiries. This is more of a swap, sort of like a CFD, if you're familiar with like what a CFD is. Yeah. So this is another innovative thing in derivatives that's kind of unique to crypto, because the market trades 24/7, 365. So there's no like.
Are you flexing on us equity people right now?
Yeah. It's like,
by the way,
it trades all the time. So there's no turning off the markets. 24/5. Yeah, we've been there for.
I am jealous, to let you know. All right.
Well, there's also they're getting into like stocks now, and like you can do, let's see, pre-launch tokens. You can do, I guess they have like a whole meme. I mean, like let's look at this, like the Trump. Let's look at the Trump coin. Yeah, if you want to short this, you're paying like 17-18% annualized interest on your position. So it's kind of a lot to do some of this stuff. So like this is an interesting thing too when these meme coins go live, because you might look at it and you might be like, oh wow, it shot up and it's going crazy, but people come into like the perps markets and short it, and it's kind of like creates that like efficient market. I think people use the perps markets a lot to do some of that. There's a carry trade you can do where you can be long the spot and just short the futures. Collect the carry. So yeah, there's a number of different things you can do there. Let's see. They also have vaults, which is interesting. So you can just deposit into like a vault that runs an automated strategy. And so the APR on this one, which is it's called the hyper liquidity provider, 15-16% if you just kind of want to deposit your money and let someone else manage it.
There was an era where the APR on staking was insane on certain projects. Do you remind me a little bit of that era and why certain staking protocols had such high APRs? I know there was a lot of risk involved in some, but some did pay out those high APRs, if I'm not mistaken. Yeah,
so if you're talking about like DeFi vaults, there was an era where they were like juicing the returns on that. And the way I understood it was not sustainable for a long time, but people would be farming these vaults and it'd be like 500-600% APR.
Yes, and that would attract more.
Yeah,
in the beginning at least, right?
Yeah. Okay. I mean, they're not like that anymore, really. But
no, it was during the craze.
Yeah.
Right. Yeah. Again, risk involved, yes. Yeah. But I do remember seeing some staking protocols like some insane APR, and it was real. It didn't last long. They usually did that to market to get more people to the project, and then they lowered it things adjusted once
more people came in.
Yes. I'm not too familiar, but I do remember that.
I know exactly what you're talking about. This was just like, it was DeFi summer.
It was like just staking something, like just putting something along.
It was like they were minting more tokens. It was like it was just an interesting mechanic.
What you're saying, that rings a bell.
The one that comes to mind for that is like Olympus DAO. And they had this, it's all like weird social mechanics or like economic mechanics. So they had something called like 3,3. So it was basically like I hold, you hold. It was like a weird prisoner's dilemma type thing. But it kind of all turns into a Ponzi.
So game theory, yeah.
Game theory, yeah. The way I understood it was if you were early, you got in early, you were like...
It was like hot potato, low-key.
Yeah. It was like, you got to get in for... It was like Ponzi-nomics. We call it Ponzi-nomics. Okay. But to your point, it was a great marketing tactic because it was like it brought more people in, but the early ones always benefited. So the way I understood it was like, it was either like based off of some type of weird looping leverage where like the early deposits were taken and put into other pools and just kind of looped around, kind of rehypothecated in some ways. created that crazy like APR. The other one is they were minting new tokens. So it's like you weren't earning in US dollars. This is where I kind of get back to that like stablecoin thing. You were earning in the native token, but the liquidity was there to support it.
Right.
So that's where your like 500% APR came from, right? So if you were like, if you put $100 in and then, you know, in a week you had 1,000, but you had $1,000 worth of the token. You didn't have like $1,000, so you had to swap it.
Yeah.
So you had to be quick and you had to kind of like do some of that stuff. But yeah, there was interesting mechanics there.
Yeah.
You know, right now I would say like if you want to do that, you would go to Aave. They're not as
spell that for me.
AAVE.
Okay.
And this is where you can borrow lend. So this is
become your own bank.
Become your own bank.
Right.
That's the promise of DeFi. So let's just look at Ethereum supply APY. You're earning 1.61%. You could borrow at 2.3. So not too crazy, not too great. US dollar coin 5.2%. Hey, better than a high yield savings account.
Anything's better than a
yeah. So
no, high yield savings account. Hey, I take that back. It's valid. It's valid.
Right, but here's the thing that's interesting, I think, because let's say you have a bunch of ETH and you want to, I guess, borrow against it. So you would, I don't know, deposit a bunch of ETH. You earn a yield plus, you know, whatever else you can earn off of it, and you could borrow at 2.3%. So. Yeah, I mean, I don't know. I've seen people go buy houses this way. Like, don't sell and take the tax hit, finance it through DeFi.
Oh, really? Through
DeFi? Yeah. So like, you only pay the spread.
Right.
I don't know if it works that well with ETH, but it definitely works pretty well with US dollar coin, Coinbase, Wrap, Bitcoin. Yeah, you could basically borrow at 2.3%, assuming ETH stays high. Transfer it into US dollar coin, move it out to a bank, pay for a house. So let's say like you deposit $1 million worth of ETH, you could borrow up to 50-60%. So you borrow 600K. You could borrow at 2.3%, transfer it out into US dollars, go buy a house. Yeah. So you're only financing the house for 2.3%.
Right. I mean, if it's efficient.
But I mean, there's obviously it's kind of really risky. But
of course,
I've heard of people doing that.
Yeah. Of course. I was saying for individuals that have the disposable income or capital to where like if it for whatever reason, of course, no one's gonna want that. You make that kind of money, but. I mean, saving 2 to 3%. I mean, percents are percentages. Yeah. So I mean, the higher dollar amount you go, I could imagine how that could be really attractive.
You're right.
With somebody that has a ton of disposable income, and just like, yo, if I could save that on this, let me try it out. Let's see
right. Exactly. I've heard of people doing that. I
don't know if it was a let me try it out for them, but you know, it's been done.
It's been done. For sure.
I think there was a purchase in Florida, if I'm not mistaken, within the last 2 or 3 years. I heard about with things being purchased through the blockchain, something like that. Don't know the validity on that either, but
they're putting home equity lines of credit on the blockchain too.
Oh wow!
You can, it's kind of crazy what's going on right now.
All I gotta say is anybody watching, I would tune into Dan and Jelly's show. Not even a plug, but because like we're all gonna need to be very well rounded in the DeFi space, anyways, in the future. It's inevitable, in my opinion.
Well, I hope we do a good job of explaining it. But if you want to check out some of the more stuff we do deeper, like we do a lot of NFT things, and I don't have my wallets loaded on this computer, which kind of makes it harder to show, but on Friday we do a live stream for about an hour, and we're just on chain, we're buying NFTs, we're swapping, we're deploying liquidity pools.
That's fire, actually.
Yeah, if anybody wants to come,
and not just theoretical slides all the time, like sometimes you'll go in there.
Yeah. Oh yeah.
Show what the wallet is, with the seed phrase, all that.
We made a token one day, and now we're like LPing it and showing people how to do that.
That's so fire.
So yeah, we'll have to do more of that stuff, and hopefully we'll get you on that show too, because I think that's where you can actually see it happen live. This show is a little bit more theoretical, I think, a little more
helpful still.
It's helpful. But I mean, I think we're good. Anything else you want to chat about, or?
No, I think that's all that was on the top of my mind that I was ready. I couldn't wait to get off. Let me get Dan's thoughts on some of these things. So.
So I hope I did an okay job explaining it. Appreciate you coming on.
Absolutely. Thanks for having me on.
Yeah, for sure.
I know we've always been wanting to get, so thank you, brother.
Oh, yeah, dude.
It's fun.
Come back anytime. We'll have to get you on another show with some of the stuff. Maybe I'll come on the noon show with you and Gus. You guys can show me futures, because I have not done. I kid you not. Like I started trading stocks in like, I don't know, like 9th grade, 10th grade. I was super big into finance, whatever. Did a little bit of options. I was like a licensed broker for a little while. And then I just got crypto pilled, and I was like, "This
Crypto
is
pilled, and it never went back.
I never went back.
That's how it happens, though.
I was like, I need to just bet all of my money on this.
Yeah, I think it was a wise decision.
I hope so. Yeah. But like I said, you got to get over the initial like learning curve.
Well, again, it was one of those things. To your point that you're making is like, you can only consume yourself with one industry.
Right.
So much, right? All my thing was trading, futures, equity options, and like I was so interested in the crypto space too. But you can only spread yourself so thin,
right?
Especially to understand things at an in-depth level.
Right.
That's why I'm like very excited to ask these questions because I don't have the time to dive into the industry like you. So I'm like, cool.
Yeah.
Somebody that puts all that time and energy. I have questions and they can help me out too.
Yeah.
So.
Anytime.
We'll go back and forth.
Yeah, definitely. I want to come on and chat futures too.
Yeah, absolutely.
I never made it to futures.
No?
I only made it to equity options.
Not yet.
Not yet. Yeah. Not yet. You could probably convince me to do futures for sure.
At least a micro contract. We'll get them, guys. We'll get them.
So, but yeah, that's all we have today. Be back here on Wednesday. We got one of our recurring guests, Greg. He'll be in the studio. He's from Amber Data. He breaks down the crypto options markets, which I think is really interesting and relevant. Just to see how some of this stuff's trading. But without anything else, we'll let it go, and I'll talk to you tomorrow.
Cool. Thanks, Dan.
All right.
Cool.
Peace, guys.
Peace, guys.
Later.